All right, everybody, welcome back. This next module is all about financing your flip. Now that you know how to find and analyze awesome deals, the next question becomes how do you actually pay for them? Here's the good news you don't need to have hundreds of thousands of dollars in the bank to start flipping houses. In fact, most successful investors rarely use their own money. In this module, we're going to break down the difference between hard money, private money, and conventional loans, how to raise capital and structure partnerships, creative financing strategies that let you get started with less cash, and how to understand interest points and loan terms so you can protect your profits. Let's get into it. First, let's talk about the three main ways flippers fund their deals, because understanding these options will determine how fast you can scale your business. Number one is hard money loans. And a hard money loan is just a short term loan provided by private companies or investors specifically designed for real estate investors. They don't lend based on your income or credit score, they lend based on the deal itself. If the numbers make sense, you can get it funded, even if you're new. The typical terms for a hard money loan are around 70 to 80% of the purchase price or the ARV. There are companies that will do 100%, and they are awesome. And definitely keep them in your back pocket if you come across them. But generally, the ones that do 100% AR of your purchase price, they charge higher points. So, additionally, typical terms for a hard money loan 70-80% of purchase price or the ARV, 10 to 14% interest on those, and 2 to 4 points up front. And that's just 2 to 4% of the actual loan amount. There's also a 6 to 12 month term on a hard money loan generally, and their payments are interest only each month as well. So the pros are fast approval, you can close in days. They are ideal for flips, they're short term and flexible, and they're based on the property's value, not your finances. Some of the cons, high interest rate and fees. Short term means you need to finish quickly, and this also requires experience and a strong exit plan. Hard money is great for getting started quickly, but your profit margin must be large enough to handle the costs. Next up is private money. Private money comes from individuals, not institutions. Think of it as funding from people with capital who want a better return than the stock market can offer. This could be a friend, family member, business associate, or even another investor. Typical terms with a private money loan that we get are 8 to 12 interest, no points, but sometimes little points. The terms vary, kind of like a hard money loan, 6 to 12 months or more, depending on how you negotiate them. They usually have a flexible structure, and you're negotiating directly with the lender, which is kind of nice. So with the private money loan, the pros, they're flexible. You can negotiate interest, timing, and even profit splits, maybe even delay the payments until you're done with the flip. They're also faster and simpler than banks, and you get to build relationships and trust that can fund multiple deals. The cons, you're personally responsible for their money, so protect your credibility. And finding private lenders takes time and reputation. But once you get it all figured out, private money is one of the most powerful tools in real estate because it gives you leverage and control without the red tape you get from other banks. Next up is a conventional loan that you can get from a regular bank. Traditional bank loans are used for owner-occupied or investment properties. These are great for rentals, but rarely used for fix and flips because banks don't fund distressed or non-livable properties usually. But the typical terms are 5 to 7% interest depending on the market, 20 to 25% of the down payment, 15, 30-year terms. And as you can see from what I just said, the pros are usually the lower interest rate and the long repayment period. The cons for the conventional loans are it's a very slow approval process. They have way tougher requirements, income verification, credit. They want to know the property condition. And as I already mentioned, this just isn't ideal for a quick flip, but for a long-term rental, this is definitely the way to go. So a quick recap of the financing methods. Hard money is for speed and flexibility. Private money is really for the relationships and a little bit better negotiation with the terms. And then conventional is just really for long-term stability. But for most flippers, the best formula is use harder private money to buy and rehab the property, then refinance with a conventional loan if you want to hold it as a rental. Next up, let's talk about one of the biggest myths in real estate, that you need to be rich to invest. You don't need to have all the money yourself. You just need to know how to structure the deal so everyone wins. So first up is just finding a capital partner. And a capital partner provides the funds, either for the purchase, rehab, or both, in exchange for a share of the profits. You provide the deal, the execution, and the management. They provide the money. That's how many new investors get started. You bring the opportunity and the hustle. They bring the capital. You split the profits 50-50 or based on contribution. For example, you find a property that needs $150,000 all in purchase and rehab. Your investor funds the full $150,000. You handle the rehab, contractors, and the sale. When the property sells for $200,000, after costs, you net $50,000 profit. You split that 50-50, both sides win. So, where to find private lenders and partners? This could be as simple as your family, friends, coworkers. Start with the people that you already know. Another place is real estate meetups and local real estate investor associations. Another spot is online investor groups, such as like the Bigger Pockets platforms. If you find someone local, I wouldn't just take someone's money off the internet. You want to meet them, verify with them that they're a real person, and start building a relationship. That's essentially what a private money partner is going to be anyways. You want them to be as tight as can be. You guys want to be like best friends, essentially. And once you get a couple of these deals under your belts with another partner, start posting on social media, LinkedIn, Facebook, Instagram, and share your projects. You'll be surprised how many people within your network may want to invest with you as well. And if all those other things start to fail and you're really feeling down, next time you go to the doctor's office, bring it up. You'd be surprised how many attorneys, doctors, or other professionals look for passive income that they have just sitting in their bank account, sitting in their savings, getting less than 1% interest each month. They want to find ways to invest as well. So just remember, you're not asking for a handout. You're offering an opportunity. You're showing people how they can safely earn double-digit returns backed by real estate. To build trust and credibility, when pitching investors or partners, just be transparent. Show them the deal, the numbers, and your plan. Always underpromise and overdeliver. Provide updates during the project and treat their money like it's your own. The fastest way to raise more money is to protect your investors' capital and make them a profit. So this next section I would like to talk about is creative financing strategies of how to finance these properties. So sometimes the best deal happens when you get creative with your financing. Let's go over a few strategies that can help you close a deal even when traditional loans aren't an option. The first creative finance strategy we will say is seller or owner financing. The seller acts as the bank. You pay them monthly, often with little money down. Why it works: the seller gets monthly income and interest. You get the property without a big loan or strict underwriting. For example, you agree to buy the property for $200,000. The seller finances $180,000 at 6% interest for 3 years while you renovate and sell. You get to avoid the hard money lender completely. Additionally, they may even finance the entire 100% at a lower interest rate that you would be getting your hard money loan or your private money loan. You have the chance to be more flexible with the terms with the owner in those types of situations. Number 2 is subject to, which you take over the payments on the seller's existing mortgage while the loan stays in their name. This works when a seller is behind on payments or just wants out fast. It's great for flips or even BRRRR deals. Just make sure to work with an experienced attorney who has done a sub-2 deal before. The last creative strategy that I'm going to talk about in here is just a lease option or like a rent to own. You lease the property with the option to buy later. This gives you control and access to potential equity while minimizing the upfront cost. It's a creative way to test a property or market before committing fully. The key takeaways with the creative ways are: the more financing tools you understand, the more deals you can do, even when banks say no. Creative financing is how you turn limited cash into unlimited opportunity. So this last section is understanding the interest, the points, and different types of loan terms. So before we wrap up, you need to understand how loans actually work. Because if you don't know your terms, you don't know your profits. Number 1, the interest rate. This is the annual percentage you pay on the loan balance. With hard or private money, you're often paying interest-only monthly payments, meaning you're not reducing the actual principal until you sell or refinance. The next term that you want to know are points. Points are upfront fees paid to the lender at closing, usually 1 to 4% of the loan amount. Example, if your loan is $200,000 and the lender charges 3 points, That's $6,000 due at closing. Points directly impact your profit, so always factor them in to your analysis. The next thing is the term length. Most flip loans are 6 to 12 months long. You pay interest during the term and repay the full principal when you sell. If your project runs long, some lenders charge extension fees, usually 1 point per extra month, but always plan for delays. A few other fees to watch out for are the appraisal or inspection fees, the loan processing fees, and draw fees for rehab funds released in stages. These add up fast and can easily shave 3 to 5K off your bottom line. So, quick pro tip, when comparing lenders, don't just ask, what's your rate? Ask, what's the rate? How many points? What's the total cash to close? And are there any junk or extension fees? The cheapest looking loan isn't always the most affordable once you add everything up. So, there you have it. You now understand exactly how to fund your flips, even if you don't have tons of money saved up. To recap, hard money gives you speed, private money gives you flexibility. Conventional loans are great for long-term holds. Creative financing opens doors most investors overlook. And understanding loan terms, points, and interest protect your profits.